Thank you very much for joining me this evening. This is 10 top tips to help Brits retire successfully in Australia. My name is Paul Davis, and I am a director, founder, and advisor here at BDH Sterling. And joining me today for this presentation is one of my advisors, Paul Lawson-Tyers, who's been with BDH Sterling for over 10 years now, and he'll be joining in this presentation. You can see him in the box in the corner at the moment. So hopefully you're all in the right presentation, and we'll get started. So first of all, just a little disclaimer that this is obviously sort of advice and information, so please don't kind of take what we say and literally kind of run with it. We would need to like provide with kind of specific advice and taxation advice before you continue. So the introduction. So Australia is always a popular destination for immigrating Brits. There's several reasons for that. There's obviously the language, climate, lifestyle. There's over 1 million Brits in Australia. So Brits obviously always attract Brits to the same place. And amongst those in Australia, at least a quarter of those Brits are retirees. What's important though to remember is before you go is to take that step in taking planning. So what we're going to cover today in the presentation is an overview of the issues, consider retirement planning details, what you can do now, and the steps to a successful retirement in Australia. So first of all, it's how and when to retire. So the first thing to consider is the changing face of retirement. It's kind of no longer a single event. So a couple of generations back, someone would work for the same company for 30 or 40 years. They would work till they're 60, 65, get a handshake from the boss and a gold watch and disappear up into the sunset. And that was pretty much it. But say these days, it's no longer a single event. People are phasing their way into retirement. So they might be staggering or just working less hours before they retire. They would typically have worked for more than one employer during the course of their life, so they build up different pensions and different pots. And now with the world a much smaller place, people would be moving around the world to retire, which certainly wouldn't have been common 30, 40, 50 years ago. So one of the key things to do is deciding what you want to do in retirement. Now, there's no right or wrong answers for this. People can be quite aspirational. They might want to go on a round the world cruise, or they might just want to join their local bowling or golf club and just kind of have an easy, relaxing type lifestyle. But one of the things we always consider, whatever you want to do, it's an important part of the planning when you speak to an advisor to talk about what your goals and your objectives are going to be in retirement, because it may be that you can achieve something you didn't think you could achieve, or you might be a little bit too aspirational. But either way, it's important to put that planning in place. Very important and very pertinent to this particular presentation is making the decision of where to live. So I think the first thing that people are considering here is either the UK or Australia. and if they, or potentially even living between the two. And what do you want to do? Where do you want to? Do you want to stay in your current home? Do you want to move elsewhere? Do you want to downsize, move closer to your family? Do you want to move away from your family? Are you a townie? Do you want to live in the countryside or closer to the beach? Or, you know, maybe looking at Australia, there's various different states which all have their plus points and their appeals. So at this point, I'm going to hand you over to my colleague, Paul Lawson-Tyers, who's going to talk you through one or two more of the kind of specifics from the financial advice and planning perspective.
Yeah, thank you, Paul. Good evening, everyone. So yeah, just taking you through some of the sort of financial things that that you will need to think about. So the first one is to do with the mortgage, and it's the case with a lot of different assets that perhaps the way that you treat them is different now than it might have been traditionally in the past, and it's the same also with pension options, etc. So when it comes to the mortgage, it's always been the case that people want to pay off their mortgage before they get to retirement. You know, have a clean slate, if you like, and then use their pension funds to fund their income requirements, traditionally by buying an annuity or taking a pension from a company-based scheme. But the way that the mortgage market has changed over the years has changed the way that people are planning as well. We're in a situation where we have very low interest rates across the world at the moment in terms of borrowing. So from that point of view, people aren't necessarily that desperate to pay off the mortgage, and perhaps some of their investment funds can continue to do very well for them and be funding that mortgage rather than taking necessarily big lump sums out of those investments to pay off the balance of the remaining mortgage when they decide to retire. They might actually be getting more in terms of investment returns than they're paying in mortgage repayments. So it's just one of those things to bear in mind that it's not for everybody, but it needs to form part of the planning at the moment, the way that these assets change. So yeah, moving on to one of the first questions that people really need to think about when they retire is, are you going to have enough money? And one of the things that is really important when you look at how much you're going to need in retirement is being realistic about your spending, ensuring that you know exactly what you need to spend in terms of covering bills and things like that, food, shopping, and those items that are perhaps a little bit more luxury. Can you afford to go on that world cruise in year one, or do you have to maybe delay things over the course of your retirement? So it's important to know exactly what you're going to need to spend, and to be realistic about your objectives going forward. So when doing the forecasting, we always have to think about things like inflation. If you have $100 now, then that's going to buy a lot more than $100 could do in 10, 15 years' time. So you need to make sure that the investments that you have are generating enough in terms of investment growth to cover the inflationary aspect. Clearly, as I said before, with the mortgages, we're in a very low interest rate environment at the moment. If you just put all your money in the bank and relied on that over time, then on the computer screen it might not be going down in value, but with the effects of inflation, then effectively your money is reducing as you go through retirement if you're not doing something with it. And we also need to think about the different taxation treatment of different assets, etc. So moving on to thinking even further about what you're going to need to have in retirement, we have to think about average life expectancies. Of course, they're averages. Some people unfortunately pass away earlier, some people live a lot longer. But in general, if you're retiring at age 65, you can expect to have a retirement of 20 years on average. But when we're doing financial planning, we have to think very carefully about this, and you'll find that a lot of financial planners these days are doing stress testing, if you like, the advice that they're giving and the investment decisions that are being made to ensure that funds would be able to last for longer. So typically, for example, seeing what the investment, what the assets, the investments might look like by the time you reach 100, because there's a lot of people that are reaching that sort of age now, or at least getting very close to it. We've seen, even in the press in the last year, Captain Moore and of course Prince Philip as well, both both right up there, 99 and 100. So we do need to think very carefully about how long your funds are going to need to last. And can you go as extravagant as you might like to in the first 10 years, bearing in mind that the funds might have to last for a bit longer? This is where very careful cash flow forecasting can be useful in terms of, as I said, stress testing. So saying, well, if you do this, what effect will it have on the long term? Or if you delay these decisions or bring these decisions forward, what effect is it going to have? And that can be really useful in terms of the planning. So looking at sources of income. By the time you reach retirement, you may well have various different sources of income. As Paul was saying earlier, people don't necessarily fully retire when they get to retirement these days. You might have some sources of income that work income, self-employment income, things like that, as well as various different assets and investments. So the important thing, first of all, is to look at the tax efficiency. What order do you take benefits in, from various different places? People naturally think, well, I've built up a pension fund and that is going to pay for my pension income. But it may well be that actually drawing on some of your other investments first and using the tax allowances that are available to you in terms of the personal threshold and things like that may well actually be more sensible to preserve a fund in your pension that might be growing nicely in the investments at the time and be in a maybe more tax efficient environment for the growth. It's important, particularly if you've still got assets in the UK when you reach retirement, is to know how the double taxation agreement is going to work between the two countries, to again work out which assets you use first in terms of providing for your retirement income and potentially transferring assets from the UK to Australia. Pensions, depending on the type of pension that you're in and your circumstance, your objectives, etc., it may well be that actually transferring your pension from the UK to an Australian pension scheme before you start drawing on it would be a lot more tax efficient than leaving it where it is in the UK and drawing on it when you're an Australian resident. And this is why we do a lot of work with clients around their pension funds and working out what the best position for them is, and it's very often transferring it to Australia. So we very clearly need to consider that tax aspect. So yeah, moving on to the actual assets that you use and the general sort of mix that you might have of different investments. I already mentioned earlier, you might have some work earnings still. You might have set up a small business when you get to retirement. A lot of people decide that, or once they go into retirement and things are a bit more relaxed, that might be the time to actually start to make some money out of hobbies that they're good at, for example, and you might have some money coming in that way. But then, of course, you do have pensions. You have state pensions that will kick in due course. You have personal pensions called superannuation in Australia, their version of it. You might have company schemes, sort of old final salary schemes. Again, it's worth looking at whether you should actually transfer those to Australia, but we need to be very careful about what you did there. And then you'll have other sort of savings and investments, things like ISAs and other types of investment portfolios that you might have, stock shares, bonds. They might be onshore in Australia, they might be offshore. You might have property income coming in. So in general, you know, a lot of people will have different sources of income. So then it becomes a case, as I said earlier, of deciding where you draw the income from when. And again, you know, if you're doing some sort of proper forecasting, then you can work out in each year where the income should come from. And, you know, if you did it differently, what effect would that have on the future? And you can very clearly sometimes see that actually money runs out a lot quicker if you get it in the wrong order in terms of how you draw that income. And also, as I said earlier, it's the taxation aspect as well. We've got ISAs up on the screen there at the moment as an example of a saving and investment. If you're living in Australia and you have an ISA in the UK, it won't have the tax efficiency that it has as a UK resident. The Australian authorities do not recognise that tax-free wrapper that you have and would look straight through it to what you're actually investing in. You know, if you're making capital gains, you'd be subject to capital gains tax on it. So it's important to ensure that as you make this transition between countries and you then make the transition into retirement, you've got all your affairs set up in the most tax efficient way, in the right investments, to make sure that you can maximise all the opportunities that are available to you. So yeah, as I said, you know, it may well be that moving funds, your assets from the UK to Australia would be very much to your benefit. There are two different taxation regimes. I've already mentioned about how the Australians would view an ISA differently to the UK. There might be opportunities around the double taxation agreement that I briefly mentioned earlier. So it's a case of knowing exactly where those opportunities lie, but also where you could come unstuck if you get it wrong, particularly in terms of the timing of when you do these things. There can be sometimes, depending on the asset, it can be that it would be better to sell it in a different tax year to the one that you might be in at the moment, or pre or post your emigration to Australia. So it's important to ensure that you know how the timing of when you do various different things is going to affect the position going forward, and therefore the ability of your funds to be able to provide for your retirement in the future. Next slide, please. Okay, so this is the final bit that I'm going to talk about, and then you can get a change of scenery back to Paul again, and that's the UK state pension and the Australian age pension, which is their version of the state pension. So, a couple of important things about the UK state pension. One, unlike personal pensions, things like that, it can't be transferred in its entirety. You can't go and get a transfer value from them and make a transfer. You will still be entitled to a UK state pension when you get to state pension age, as long as you've paid at least 10 years worth of national insurance contributions. If you've paid less than that, you wouldn't get a state pension, but there may be an opportunity to top it up. That is available as an option. If you've paid 35 years worth of national insurance contributions, then you will get the maximum state pension. If you've paid somewhere in between, you will get somewhere in between in terms of the amount that you will receive when you get to retirement. Now, a lot of people think that the state pension stops being increased in line with inflation as soon as you move to Australia. That's not the case. You know, if you're 45 now and you obviously got a state pension age of 66, 67 in the future, then you will still get the inflationary increases between now and then. It's when you start actually drawing on it and you're a resident in Australia, you will not get the inflationary increases that a UK resident would get on that state pension. So, you know, you draw your pension, you'll get the same as a UK resident on day one for the number of national insurance contributions that you've made. But a year later, a UK resident will get an inflationary increase and you won't. So it comes back to what I was saying earlier about how $100 now would buy more than $100 in 10 years' time. Well, you need to consider that that's going to be the case with your state pension as well, in that you will be you'll be able to buy less with that money in the future because you won't get the inflationary proofing on it. It's unfortunate, it's been through every court in the land, but it's just not possible. Now, when you get to retirement, there is the opportunity to potentially, if you can afford to, if you don't need the money at the time, but potentially defer the pension for a bit longer. And the UK government does give you a bit of incentive with that. They will enhance your pension pot a little bit for doing that. But the important thing is, while it's in deferment, it will also continue to get the inflationary increases. So that can be an option. Obviously, if you need the money, you need the money, but it can be an option for those people that are not so reliant on it to perhaps be able to get a slightly higher starting value when they do start to draw on it. When you're living in Australia and you're drawing on the UK state pension, it will be subject to tax in Australia. Now, it will depend on whether you've got other taxable income at that time. If all of your savings and investments, etc., are in an Australian superannuation fund, well, from age 60 you can start drawing on that tax-free. It's not going to be subject to tax. So if you have no other taxable income, no rental income, no other investments that are generating income that would be subject to tax, then you may well find that the UK state pension will fall within the personal threshold in Australia under which you pay no tax anyway. But it's something to consider. You will be, of course, subject over the years to fluctuations in the exchange rate. And that's an important thing to consider as well. So with a lot of people, they find that the best thing to do is to keep a UK bank account open when they move abroad, and then have the state pension and any other pensions that remain in the UK paid into that UK bank account. And then they can use a currency broker, like, for example, Halo Financial, who we're very keen on using, who will then be able to convert those funds for you at commercial rates, and you'll be able to pick and choose the time that you go into Australian dollars rather than having the money paid directly over to an Australian bank, effectively getting tourist rates on the conversion. And because it's a set day when it's paid, you'll have no idea from one payment to the next what the exchange rate is going to be. So it's perhaps a bit easier to have the money paid into a UK bank account. Now, moving on to the Australian age pension, it's in a way similar to the state pension in a lot of ways, that people accrue it over their working life. As long as you've been in Australia for 10 years by the time that you reach the Australian age pension retirement age, then you would get some sort of pension from them. But unlike the UK pension, it is means tested. So it will depend on the other assets and income that you have as to whether you would ever be entitled to an Australian age pension. The way I see it is really you should be aiming to fail that means test on the Australian age pension by a long way, because that will mean that you've got loads of other assets and income to rely on rather than just the Australian age pension. But if it is a bit more borderline by the time you get there, there are things that people can do to plan for it and ensure that they will get some sort of Australian age pension. For example, main residence is not counted within that asset test. So I've heard of people who don't want to move into a bigger house because they're retiring. If anything, people tend to want to move to smaller houses by the time they get to that point. Children have flown the nest, etc. But what they might do is move to a similar size house, but in a nicer neighbourhood. And so they'd be paying that little bit more for the house, but they'd be living in a much nicer area. And not only do they put themselves in a nicer area for their retirement, but also it helps to just bring their assets below that threshold so that they get the age pension. And in Australia, with the age pension comes other benefits. So I liken it. I don't think this is the case in Australia because it's such a big place, but I liken it a bit like the bus pass in the UK, in that everybody would get the bus pass in the UK, but in Australia, it would only come to you if you also get the age pension. So it's just something to bear in mind when you're thinking about the future. You know, how is your state pension going to be treated? How are you going to be entitled to an Australian age pension? Is there anything that you can do as you get towards retirement age where you could reposition your assets a little bit in order to ensure that you do pass that means test if you're a bit borderline at the time? So that's enough of me rabbiting on. Anyway, I'll pass you back over to Paul now.
Okay, thanks very much, Paul. Moving on to talk about some of the more kind of general things around retirement and what to consider. Well, first, would like the emotional aspects of retirement. So it is a significant life change, and it is the start of your next chapter. But some people aren't ready to take that next step and start that next chapter. Some people are. My dad retired in the 90s when he was 52, and he was very happy doing that. He's had coming up to 30 years of retirement. He's been very happy. Similarly, I know some of my friends' fathers are still working in their 80s. Because it's part of their life. It's something they really enjoy in terms of their work. So it's something really to consider, and I guess that ties in with being kind of mentally stimulated as well, and finding things to do in your retirement. And yeah, it's more than just the money. It's the time. Can you spend more time with your family than you've been allowed to throughout your working life? And is it something that you really want to do? I mean, say a lot of people do in retirement, moving across to Australia, do it to spend more time with family members that are already over there. But yeah, it's a big step. So not just financially, but emotionally as well. Finally, and morbidly, it's what if you don't make it to retirement, because not all of us do. So there are several things to consider for your loved ones and your potential beneficiaries. I mean, one of the points and one of the things we look at with regards to pension planning is what are the death benefits that are provided for the members' loved ones in the event of their early demise. Is there the opportunity, or would it be prudent to take out life insurance? And also inheritance planning is crucial for people kind of with the larger estates, to make sure they make the appropriate wills if they're living in Australia but have assets in the UK still. Make sure that they've got wills in both the UK and Australia, and they mirror each other. And also, if you are moving to Australia, take the appropriate advice to break your UK domicile. UK, as you're aware, has inheritance tax. Australia doesn't, but just by moving to Australia wouldn't necessarily mean that you have eradicated your UK inheritance tax exposure. So very important things to consider. So in summary, we've just gone through some key steps to ensuring your retirement is successful. How we work, we would put together some planning, and we would do regular reviews to make sure everything's tracking. Things change all the time. You can put together a 5-10 year plan, but with all the will in the world, things change, and it's important to have that financial advisor to hold your hand and make sure to adapt as and when circumstances change. Tax efficiency helps you maximise your available income. Paul touched on that. and there are emotional challenges as well as financial. And finally, how can we help, or why would you come to BDH Sterling? Well, we've got plenty of years of experience helping people that we understand the challenges of retiring in a different country. We can provide the advice and support every stage of your journey. So pre-migration, post-migration, pre-retirement, post-retirement, and into retirement. Financial planning and support with the understanding of the emotional aspects that people go through when stopping work. And our hope is, through our office here in the UK, through to our offices in Australia, an ongoing relationship over many years. And finally, as touched on, we've got offices in both the UK and Australia. We understand the complexity and the potential pitfalls. We're uniquely placed to support retirement planning, and we can offer that genuine one-stop shop, as I said, because we can transition across from the UK to Australia. And on top of that, we also have our sister arm, which is BDH Tax, which can help with some of the finer aspects of tax planning and completing tax returns. So we're on to the stage where over to you guys, and if you've got any questions.
Right, so we've had a couple of questions in already. First one that I've just seen is about inheritance tax in Australia. The good news is there is no inheritance tax in Australia. But the bad news is that whatever you do to try and break your UK domicile for inheritance tax purposes, it will take at least 3 complete UK tax years to break your domicile. Once you've been outside the UK for more than 3 complete UK tax years, so for example, if you emigrated today, that 3-year clock would start on the 6th of April 2022, so finish in 2025. And from there, you would not naturally necessarily be deemed to be a domicile of Australia. But if you have set up your affairs in such a way to demonstrate that you have no intention of returning to live in the UK, then you would no longer be a UK domicile for UK inheritance tax purposes. Now that's important, because if you're a UK domicile, then your worldwide assets would be subject to inheritance tax. If you are deemed to be domicile in Australia, so if you've taken on Australia as your domicile of choice, then and you've done everything necessary to ensure that that is the case, then at that point it would only be your UK-based assets that would be subject to inheritance tax. So if what you've got left in the UK, if anything, is under the inheritance tax threshold, then it doesn't matter if you've got 20 million in Australia. It only would matter what's in the UK once you've broken that domicile. But while you're still UK domiciled, it would be your worldwide assets. I hope that answers the question.
Okay, I've had another question. What are the rules about moving proceeds from a house sale to Australia? Well, the situation there is, I guess one of the questions need to consider is actually when that house is being sold. So obviously if you were selling prior to going to Australia, you've got that kind of cash in the bank and you're then moving it across to Australia. There's no there'd be no kind of tax implications or no worries with that. One thing you would need to consider, or I would strongly suggest you consider, because obviously with pensions and house sales, they tend to be kind of the larger of the assets that you move across to Australia, is get us kind of suitable currency exchange broker to work with, and we work with many in order to maximise what you can get in terms of in terms of an exchange rate into Aussie dollars when you move across. I hope that's kind of answered that. As I said, when we come to the end of this, there will be an inquiries page. So if you an inquiries link that you can ask any questions once we finish. We don't get around to answering all the questions tonight.
Okay, there's a question here from Levi about when is the best time to start working with us, and if you're still working and perhaps haven't got masses of assets, what do you do as far as working with us is concerned? Well, what I'd say is probably the best thing to do is get in contact with us via the inquiries stage, and we'll have a bit of a chat about your situation, what you have got, what your plans are, and then we can work out what sort of service we can provide to you, and when would be a good time to start doing the planning. Is there anything that's immediate that needs addressing, or can it perhaps wait until you maybe speak with one of our Australian advisors when you arrive on the ground over there, and they can start helping you to plan for your future over there, because we have 3 offices out in Australia as well. So yeah, it's a bit of a hard one to tell without knowing more about your situation. As with a lot of financial planning, we need to understand your situation. But yeah, just make the inquiry, and we'll have a quick chat with you, and we'll work out what you need to do when.
Okay. Another question come in. When should we start planning moving employee pension plans into QROPS or equivalent? So someone's obviously done a little bit of their research, or maybe it was one of our previous presentations. So in terms of transferring from the UK to Australia, your pension plan, there's a couple of things to think of. First of all, you couldn't actually physically transfer it to Australia until you're actually in Australia. So that's the first point. The second point is the way that the rules are at the moment for transferring pensions overseas with regards to transferring to an Australian scheme. You do actually have to be 55 before you can actually transfer it to your UK pension to Australia. That said, it doesn't mean you should just do nothing. There are things you can do, or maybe more appropriate vehicles that you can hold your funds in the UK in readiness to transfer at 55. For example, you might be able to hold your funds here in the UK in Australian dollars to match your lifestyle. So that's a very good question, and again, it's kind of dependent on the individual. But yeah, when can you start transferring? Well, you'd have to be in Australia. You'd have to be 55, but there are other things you can do.
Okay, there's another question here about under Australian super, when can you draw from it? So under Australian superannuation funds, there's something called the preservation age, which determines when you can draw your benefits, and it will depend on your age, although that will be redundant before too long. But essentially, if you were born before the 1st of July 1960, your preservation age is 55. If you're born from the 1st of July 1964, then your preservation age is 60. Or if you fall into one of those tax years in between that, then it will be somewhere between 55 and 60 as your preservation age. Now that's when you can start drawing on it. Even if you can draw on it a bit earlier than age 60, it's not necessarily going to be tax-free until you hit age 60. It is in a lot of cases, but it becomes naturally tax-free once you hit 60. So yeah, that's basically how that works in terms of when you can start drawing on it.
Okay. Another question coming. If you kept your house in the UK how would rental income be treated when living in Australia? So yeah, that's a very good question. So there's the first point I would make is it does depend on what visa you're in, or you in Australia. So you could be on a temporary visa, a provisional visa, or a permanent visa, and ultimately you could, get citizenship in Australia. But depending on what type of visa you're on, will depend in what jurisdiction you're taxed. So the general rule of thumb, if you're a permanent resident of Australia and have been resident of Australia, the taxation rights overall are in Australia, as just the nature of the dual tax agreement between the UK in Australia. In some cases, and on some assets, some income, it might mean mechanically you might be taxed twice in as much as you're taxed, first of all, at source in the UK, and then overall you get credit for that in Australia. Where that's very important, service that we provide is BDH Tax will be able to help you with aspects such as that as your tax return. So there are several steps. If you're renting out a property, you'd have to make sure that you have applied to the HMRC here to be a non-resident landlord and a permanent resident of Australia, and overall the taxation rights are in Australia. But it is important to take tax advice when keeping a rental property, because of course there's the income aspect, there is capital gains tax aspect when you finally come to sell that property, and also any properties that you keep in the UK will still fall into the UK IHT tax net. So there's quite a few things to consider there, and it's quite important to take advice if that's something you're considering. It's a very, it can be a very doable thing to do, but it is important to take advice.
So moving on to Lindsay's question about ISAs, you ask whether because ISAs are taxed when you live in Australia, would it be worth selling them before you move to Australia and just bringing the cash with you? Well, that's a question. It very much depends on what you're going to do with that money. What's happening with the actual ISAs that you've got? If shares, are they actually doing very well at the moment? Is it a good time to cash them in, or are they perhaps down in value at that time, and it's not a good time to essentially crystallize that loss by taking the money out? What's the exchange rate doing at the time as well? It's all very well cashing it all in, but if you're not going to move it into Australian dollars and just transfer it over in sterling, what sort of options are you going to have in sterling in Australia to invest? And also, Australia don't really have a natural sort of ISA equivalent, so it would be very much a case of, well, if you took the money over there and you invest in something different, is it actually going to be any more tax efficient than what you're already in? So it's one of those things, like with a lot of financial advice, if you just purely based it on tax, didn't think of the wider picture, then perhaps you might make the wrong decision. So it's definitely one to consider in a bit more detail than I can really go into now.
Okay. Next question. We're in the visa process, in this case contributory parent visa, but don't really know when it will be completed. My heart goes out to you, because you are dealing with kind of Australian civil servants there in immigration, and they are one thing you can rely on is how long they take, I guess. How far in advance would you recommend engagement with yourselves prior to the visa being approved? Well, look, the way we work is we can have an initial consultation chat with you, which we don't charge for, which we can just have a little chat and just understand your situation, and it may be appropriate to engage us now or maybe in the future. The other thing to think about is what we do first and foremost is financial planning. So if you do engage us, we can kind of set out your situation and discuss what you need to do. We don't necessarily have to implement anything until the time comes. But a lot depends on what assets you have, the structure of your pensions. As you know, are you at a point where you're forced to for your UK pensions to come into payment? So if that's the case, there might be other key things or key stages where you should probably take advice from us first, no matter how long your kind of visa process might take.
Great. So, Helen, hopefully I answered your question about stocks and shares portfolios in the UK when I sort of went through the ISAs in terms of, well, it depends on a number of factors. So hopefully that covered off. But you know, if you've got any other questions, let us know. Luke, on the chat, you've mentioned about UK pension contribution tax relief. Well, it sounds like you've certainly done a bit of research there, Luke. Yeah, you've got it dead right. You know, if you've got the opportunity to pay money into your pension scheme, get UK tax relief on it, and then potentially transfer it over to Australia in due course and get everything tax free in retirement, you're really enhancing the benefit of that tax relief that you get from the UK government, because you don't give it back. You get it, you get investment growth on it over the years. But of course, it's very important that, you know, if you're doing that when you're, you know, 40, 45 years old, you need to understand that you're not going to access that until you're age 60 if you're drawing it from an Australian superannuation fund. So it needs to be money that you're happy to lock away for that length of time. And it's not going to make you poor in the meantime, obviously. Just moving on, just before Paul, you look at any other questions. Raz, I think I might recognise you. Anyway, you asked about rental income and whether that can be contributed towards UK pensions. So potentially a little bit, and that's that. Once you've left the UK, you would not be you would not have any UK relevant earnings on which to base contributions. But if you don't have UK relevant earnings, you can still pay up to £3,600 into a pension fund. So you'd pay £2,880, you get £720 worth of tax relief on that. You can only do that for up to 5 years, and you can only do that if the pension scheme to which you're contributing was already set up before you left the UK. So, you know, bearing in mind you're still in the UK at the moment, as long as you've got a pension in place that you were intending to contribute towards before you leave the country, you can, as I said, it's a relatively small amount, but, you know, it's still £720 worth of tax relief that you could get for 5 years. So, you know, you're still getting £3,500 for free if you're going to end up transferring that over to Australia in due course. So it's not necessarily going to be a home for all of your rental income, but it could be a useful little way of saving some of that money into a very tax efficient environment. So yeah, very good question.
Next question. Is there a straightforward and recognised route to transfer UK pensions into super schemes? Well, there is, I mean, over the past 17 years that I've been advising in the area of pension transfers to Australia, the rules have changed, they've evolved, they've about turned. What we can do is just make sure that people, you know, with our advice, can transfer over to Australia in the most straightforward manner. As I said, there are various different rules. For example, you can't transfer to Australia until you're age 55. There are only certain types of schemes in Australia that will allow you to take transfer in, and they're qualifying recognised overseas pension schemes. There are limits to how much you can transfer from the UK to Australia in a year. Those limits are imposed in Australia, and there are various like tax considerations for the longer you leave your funds in the UK before transferring over to Australia. So there are tried and tested routes that we've done with clients with all different sizes of pensions at all different ages, and we've managed to successfully transfer across. So it would all depend on your individual circumstances as to how straightforward it is to transfer across to Australia, but there are specifics, rules and regulations both in the UK end and the Australian end that need to be considered.
Janet, you've said that you got held up in a work meeting. Absolutely no problem. Yes, there will be a recording available. I'm not entirely sure when it will be available, but it should eventually be up on our YouTube page for you to view.
Another question I've got here: should we continue to buy UK ISAs for the next few years whilst waiting for visa approvals, or leave in separate investments due to no tax efficiencies in Australia? Well, there aren't any. As Paul pointed out, there aren't any kind of tax efficiencies in Australia, but of course there are here in the UK. And also, when you consider the alternatives, which would potentially just be put into a UK bank account, for example, where you get very little interest rate, it might be more efficient just while you're waiting to go to Australia to use your ISA allowance. Remember, ISAs, unless we're talking about junior ISAs, of course, ISAs can be kind of cashed in or taken at any point. So there might still be compelling reasons to have the ISAs whilst you are still in the UK, and then review the situation the closer you get to moving to Australia.
Look, you ask about the sort of growth in value of your pension fund between when you enter Australia and when you make the transfer over there. So you're giving an example that if you're 50 at the moment and you can't transfer until age 55, is that growth going to be taxable? Well, yes, it will be. When you make the transfer over to Australia, the growth will be taxed. It's the growth between when you entered Australia and when you make that transfer. That will be subject to tax. What you actually had in the first place won't, but any growth element will. And that's because up until you go into a regular income stream, at which point it becomes tax-free in Australia, the investments as they go along while you're accumulating them in an Australian super fund are taxed as they go along. So this tax on the transfer is essentially there to ensure that you pay the same sort of level of tax on that growth that you would have done if you'd been able to transfer on day one over to Australia. It's just ensuring that by leaving your funds in a tax efficient environment for the investment growth, that you're not actually at a benefit to another Australian resident who's been taxed as they go along. In reality, you will get a slight tax advantage because your funds have been rolling up gross each year for those 5 years, and then you're being taxed at 15% on that growth when it goes over to Australia, as opposed to having that 15% taken off every year. So you've got less going forward that's being invested. It's minimal, but it does give you a slight tax advantage to leaving it in the UK. But the main tax advantage that we were talking about earlier, and you hit on earlier with your question, is about the tax efficiency of actually paying the contribution in the first place. You know, if you pay £80 into your pension and you get £20 worth of tax relief from the UK government, or £40 if you're a high rate taxpayer, then that's where you're getting the real benefit and as I said, what you actually have when you move over there in terms of your pension fund is not going to be subject to tax. So that initial sort of tax relief and everything that you've got, that's not subject to tax. It's only any growth on that and the rest of the fund. So it still becomes very, very tax efficient to pay extra money into your pension fund while you're still in the UK, while you can still get that tax relief, as long as obviously, as I said earlier, you can afford to lock away that money until retirement.
Another question here. If I get permanent residency and don't sell my house for a year, is there tax to pay on the proceeds? Many thanks. So I presume what we're talking about here is you're moving to Australia and then selling your UK property. Well, again, that's something we can provide advice on. What I would say is you can elect for a main resident, and you wouldn't pay capital gains tax on your main residence when you come to sell that. So what I would suggest is, yeah, I mean, we're more than happy to advise if someone has got a house that's in the UK, they're waiting to sell it. If it's just a case of you're going to be in rented accommodation, I think you'd be in rented accommodation for up to 6 years, but I would confirm that in advice to you before you would be asked to consider your UK property as anything other than your main residence. But I guess the situation comes when you have retained a main residence, you've bought a new property in Australia, and that's when there might be some capital gains tax issues when it comes to selling your what would have been your main residence. So again, yeah, more than happy to have a chat about that.
A question here from Levi about, well, you mentioned about cryptocurrency, but I guess it comes down to any sort of investment other than property that is subject to capital gains tax. You mentioned about potentially waiting until you've moved over to Australia, and then realizing your asset at that point and having your capital gain at that point. Well, again, I guess it comes down to performance, to the exchange rate, etc. But it can, yeah, you're right. It can be a case of timing, and I mentioned earlier about the timing of different things and how it can really have an effect on your long-term planning. Now, in terms of something like shareholdings or other types of investment that are subject to capital gains, as I said, other than property, there's different rules around property, but other ones, once you've left the UK and the UK has entered into a different tax year, so if you left the UK today and then you sold your asset that is subject to capital gains after the 6th of April next year, then it would no longer be subject to UK capital gains tax as long as you don't come back to the UK for at least 5 years afterwards. Well, to live, you can come back on holiday, but as long as you don't come back to live within 5 years, then you wouldn't have to pay any UK capital gains tax on it. And yet, you're also right in your comment that as far as the Australian authorities are concerned, they're only looking at the gain that you make between when you enter the country and when you actually make the realise that gain. So again, if that's fairly shortly, if you're cashing it in fairly shortly after you've arrived in Australia, then you might not have made much of a capital gain then. So that's just one. That is a perfect example of how the timing can be very important. But as I said, it's a bigger thing than that, really, because it can come down to is this the right time to sell these assets in terms of the investment markets? Is it the right time from a currency exchange point of view? What other options are available to you? Are they actually going to, are you really going to benefit from it? What sort of capital gain have you made? Are you really saving much? And are you perhaps, by just trying to save yourself a couple of pounds, then putting yourself in a situation where you can't find anything that was as good as what you had? So it's one of those things that just needs a bit more careful consideration than just looking at the tax rules.
Okay, thanks. Thanks, Paul. So another couple of questions. We'll sort of join these two together. It's like, are you doing face-to-face meetings now? Just to say thank you for all your advice. I think I should be contacting you. I'm waiting for a contributory parent visa. Just don't know when to contact you. Well, as I said, if it's just a question of having a conversation, we're quite happy to have an initial conversation, and we can have that on a one-to-one basis. At the moment, we're not having face-to-face meetings in our office, but we are conducting them over kind of a video conference. So if anyone's got that kind of facility, which hopefully most of you do, bearing in mind you're on our webinar now, we can do that. Hopefully in June, obviously, when the world gets back to normal, more than welcome to visit us in our office, or advisors will be more than happy to come and see you. But yeah, we can start meetings, or just kick off with an initial phone call, and then maybe do an initial consultation over video conference for the moment, and then we can just find find and identify if there are any pressing issues for someone now.
Yeah, absolutely. Helen, you asked about the state pension, and is it better to top up the UK pension to achieve? Well, you've mentioned 30 years. You actually have to have 35 years to get the maximum. Now, as far as that's concerned, is it a good idea to top it up or not? Well, that's not a simple question to answer either. It depends. If you got a quote from the state pension that said this is how much you need to pay to get this much in terms of annual pension, it's then a case of maybe looking at, if you had that money, where else could you put that money, and what would that do for you, and could it actually give you a better result than the state pension? Now, if you were remaining in the UK, you probably find that the state pension top up is very good value for money. Becomes less so when you're moving to Australia, because you won't get those inflationary increases during your retirement. So effectively, you're paying slightly over the odds for what you're getting, but it still could be the best deal when you look at what else you could do with that money. But as I mentioned earlier, it could be that paying a contribution to a UK pension while you're a UK private pension while you're still a UK resident, and getting that tax relief and then getting everything tax free in retirement might be a better option. I'm not saying that it will or not, because I'd need to see what sort of quote that you get from the state pension and what you're buying for that. But it may well be that that's a better one when you also consider that the state pension will be subject to tax in Australia. As I said, a lot of people wouldn't pay that tax because they wouldn't have other taxable income. But if you did have other taxable income in your retirement, then taxes comes into reduce the value of your state pension again. So I'm not saying yes and I'm not saying no. It's one of those ones, like a lot of financial advice, I would need to work with you on an individual basis and know exactly what it is.
Okay. Another question come here. We will sell our home here in the UK before we leave, but we do have a flat which we bought for our children. It's in our names. Should we transfer the ownership? Our main residence will be in Australia, and just a bit more context, both over 55, the Australian husband applying for the spousal visa. So that's actually a very good question. I guess again, that's probably something would be really good to have a conversation with you about. You might be transferring it ownership. I presume you're asking, do you want to transfer it over into your children's names? Obviously, that might come with some kind of potential like IHT or estate planning thoughts. As well as you know, at the moment, there is a reasoning behind it. You're looking to kind of pay rent, or is it to narrow the amount of capital gains tax you potentially pay when you come to selling it? And I guess that will be depend on what you acquired it for, and you know, when you're passing it over to your children, what that amount's going to be. So it's a good question. I need to know a little bit more about situation. Again, you know, our details will come up at the end of this presentation. That's something we'd be happy to have an initial conversation with someone about.
Moving on to Philip's question. Philip, it's good to hear that you're on the ball as usual with this. This is breaking news from yesterday. There used to be a work test that would apply when you wanted to make a pension contribution, when you wanted to make a transfer of a pension over to an Australian scheme. Once you had reached 67, it used to be 65, then it was moved to 67, and between 67 and 75, if you wanted to make well, it still is the case just at the moment, that if you want to make a contribution towards an Australian scheme, via transfer, in this case from the UK, then you have to pass a work test, which means that in the Australian tax year, 1st of July to the 30th of June, at some point in that tax year in which you're making the transfer, pension transfer, you have to satisfy a work test, which means that you have to have done 40 hours work in a 30-day period within that tax year. Philip, you're quite right. It was in yesterday's budget that it's going to be removed from next year, from the 1st of July 2022. We are always a little bit cautious with this sort of thing, just to make sure that it actually does get passed into law, because it's not yet. We're only going to be able to rely on it once it actually gets passed into law. But what they have said at that point is that from next year, it is proposed that the work test will be removed entirely, and that's right up until age 75. Age 75 being the latest day that you're allowed to contribute towards an Australian super fund. After that, you just can't do it. It's as simple as that. But whereas we used to have this work test between age 67 and 75, they decided that they're going to just get rid of that, assuming it goes into law. In terms of how much you can contribute, they've also said that they're going to allow the roll-up that you have available. So in normal circumstances, you can transfer $100,000 in each Australian tax year as what they call a non-concessional contribution, which a UK pension falls under. You can roll up 2 additional years though, so you make a payment of $300,000, but you use up next year's allowance and the year after that. So you're using up future years' allowance. Now, as things stand at the moment, you can't do that roll up once you get, it still is at the moment, 65. You can no longer do the roll up after you've reached age 65. So you could literally only do 100,000. And then from age 67, you also need to pass a work test when you do that. Now, they have said that as well as removing the work test, they will also allow that roll up. So you can make a contribution of 300,000 as long as you've got the allowance to do it up until you're age 75. You mentioned 110,000 in your comment. I must admit, I've only managed to have a brief look at the announcements from yesterday, but I didn't see any mention of the 110. I did see the mention of the overall cap still going ahead from 1.6 to 1.7 from the 1st of July, but on initial look, I didn't see anything about the proposal to move it from 100 to 110. Paul, did you see anything?
No, I didn't spot that either, Paul, to be honest.
Okay, so I think we can probably obviously I'll do a bit more research on that, and I'll let you know, Philip. Obviously we do work together already, so I'll let you know, and if I do find anything. But as things stand at the moment, I think we can assume that 100 to 110 hasn't been changed, unless I find anything to the contrary, or you do.
Next question I've got, following on from the question on topping up a UK state pension, can you top up a UK pension after leaving the UK, assuming it's the right use of your money, as Paul mentioned before? Paul, I think the answer to that is yes. First one, we've been asked that for a little while, so scratching around, but I'm pretty sure the answer to that is yes. I don't think where you are in the world precludes you from topping up the UK state pension. It's not resident based, so I don't think there's any problem doing that at all.
You can make small. You can continue to make small additional payments into the UK state pension as well, from on a regular basis. Not necessarily at the levels that you can when you're earning money in the UK, but there's different classes of national insurance contributions, and one of those, a contribution from Australia, is allowed under that. It's only small increments, but over time it can add up.
That's it for my question and answers. Have you been monitoring the chat? Is there any more on the chat?
Yeah, so we've got one more question from Levi again here. Any idea how long the spousal visa application process has tended to take for your other customers who have received approval lately? I have to admit, I haven't asked. Visas have been a bit all over the place in the last year in terms of timescales. I have had a couple of people that I've worked with recently that have had spousal visas, but I must admit I didn't ask how long it took them to get them. They'd got them by the time they came to work with me. I know in general the spousal visa tends to be a bit quicker than something like a contributory parent visa. There you go. Reagan has just answered it. Paul, our spousal visa only took 4.5 months. That answers that question. But it also depends. Are you going for a temporary spousal visa or a permanent one? How long have you been with your partner? How much documentation do you have to be able to prove the relationship that you've got as well? But look, I'm not going to claim to be a visa agent. I get into a lot of trouble if I try to claim that I was a visa agent. We're not. We're financial advisors. So yeah, it's a case of Reagan's just said, but we've been together for 10 years and we had truckloads of evidence. Well, that's the thing. It's much easier if you've got all of that than if you've been living together for a shorter length of time, or you just don't have any evidence to back up that relationship. It sounds strange that you have to justify your relationship, but you do if you want to get one of those visas. But yeah, as I said, I wouldn't claim to be an expert, but we do work very closely with visa agents, just the nature of our business being that we've been working in emigration circles for many years now. We do tend to know some good visa agents, currency brokers, removal companies, even pet transfers, things like that. We do know some decent companies to use. So feel free to ask, and we put you in contact with somebody. I do have a couple. I have a couple of other comments in here. I'm not sure what they say. Again, it's about the. It's about the visas. Yeah, thanks, Levi. Yeah, I'm definitely not a visa agent. I think I've made that clear now. I have a good friend who is an Australian visa agent, and he's had experience of people going around trying to give loads of information about how visas work, and they usually get it wrong slightly, and that just causes a big headache that the visa agents then have to try to unravel. So yeah, it's like with so many things. I wouldn't ask a plumber to rewire my house necessarily. So same thing, don't ask a financial advisor to give you visa advice. There's better people to do that for you.
One question has just popped up. It says, you mentioned the possible advantages of paying UK state pension into a UK bank account. Can you keep a UK bank account if you don't have a UK address? The answer to that is yes, you can. It might depend on the bank, but we have plenty of clients who keep a UK bank account open, and it's quite a prudent thing to do because one, yes, you might have state pension payments coming in. Two, you might receive some kind of like inheritance or something like that from the UK, so it'll be easier just to have it paid in a UK bank account. And finally, people do when they move to Australia, they don't like never come back to the UK again. So it's always handy to have a UK bank account and have like kind of one, just some like funds building up in that, just to save you from doing the currency exchange every time you come back to the UK. So yes, you can have a UK bank account.
Yeah, and even if you don't have funds at that time building up in that UK account, having a UK account to which you can transfer funds from your Australian bank account via a currency broker means that you can get commercial rates when you convert your funds, as opposed to going to your local bank and asking them to give you cash over the counter, in which case you essentially get tourist rates. So yeah, it can be very useful, and I was just literally having that conversation with the client earlier about keeping a UK bank account open for that very reason. You're unlikely to be able to keep a savings account open. That's one thing I seem to have found with my clients, that they can't usually keep a savings account open. They can only keep a current account open. And as Paul said, it will depend on your bank. You need to ask them the question as to whether you can keep that.
I mean, most UK bank accounts will allow you. I mean, as far as you concerned, you guys are going to Australia rather than somewhere where they have to worry about geographical limits or anything like that. But I wouldn't say it's a given that your bank account will definitely allow you to open on a overseas address, but most do. So,
Lindsay, you've asked a couple of questions there. Finally, on your final point, where you say you're waiting for a visa and just don't know when to contact us, just contact us. We can have a good conversation with you about your situation, and we can work out from there. Do you need to start having the conversation earlier? Can it perhaps wait a little bit longer? Is there anything that we need to address in the short term? I always say that it's better to speak early and then defer the conversation another few months than to start speaking in a few months' time and find that we've actually missed an opportunity by delaying it when we could have had that initial chat to start with. So yeah, just make the inquiry. One of us will be in contact with you. You've also you've asked the question, if you get permanent residency and don't sell your house for a year, is there tax to pay on the proceeds? Well, if it's your main residence and you're selling it a year after you've left the country and you haven't bought, and this is important, you haven't bought an Australian property in the meantime, so it's still technically your main residence that you own, then you should find that that will fall under the main residence exemption in both countries, the UK and Australia. So you shouldn't have to pay any tax on that. If it was longer than that, it would very much depend on what you've been doing with that property. Have you been renting it out, for example, or not? How long has it been? If you were leaving it there for 10 years, it might be a slightly different matter to 1 year. So, just important to make sure that you understand the rules around that. But if you're phoning us about other things anyway, then we can sort of go through that. And if your situation were to get a bit complex on the tax side of things, we can always get you talking also with BDH Tax, our duly qualified accountant sister firm, who would be able to give you the specific sort of tax advice to go alongside our financial advice.
One more question. I was just following up on the UK bank account. Yeah, I mean, all correspondence would go, all correspondence or cards, if you've got an Aussie address, would go from your UK bank account to your Australian, would go to your Australian address.
Any others on your side, Paul?
None on my side, no more. I think that was
well, we've had a lot of questions tonight. That's
we have.
Out of all that I've been involved in, this is you've certainly been the most active audience. So
yeah, no, really do appreciate
all your questions. That's really good.
no, I really do appreciate that, because these a lot of these types of presentations do work a lot better with participation. So thanks for all those who've asked questions, and thanks for all of those who've stayed to the end of this. And as I say, if you've got any further questions, we've got, as I say, the inquiries at bdhsterling.com email address to ask the questions to. Oh, just as we said, these are the last ones. I've just seen a couple of things pop up. Oh, saying thank you very much. It's been excellent. Oh well, okay. Thanks very much. We like that even more. So thanks very much. But yeah, as I say, but thank you guys for your participation, because it does make a huge difference to these sort of presentations. I really appreciate, particularly those souls that are now at, what is it? It's like, oh, it's 10 to 9, and they've seen this through to the end. So thank you so much. As I said, please feel free, if you don't think, there's the inquiries at bdhsterling.com email address if something comes to you now, or just give us a call, particularly if you are concerned that you think you need to start planning now. As I say, it's not necessarily about waiting for your visa, or it's about you coming up to the point where you're moving. There might be some other life events here, like you're coming up to retirement, or you think you might be in line to inherit something, or there might be one or two other things which kind of could affect something, might be in the short term, but affect your planning in the long term. So please feel free to pick up the phone or drop us an inquiry.
And don't be too concerned if you think that perhaps, I'm not really sure that I want to bother with this question or whatever. Well, look, I think if in doubt, just give us a shout anyway. It may or may not be that we can work with you, bring much benefit to your situation or not. But we'll always be happy to give you a couple of minutes just to run through your questions, make sure that you're doing the right thing. I was having exactly that same sort of conversation with somebody earlier today, where it turns out that there was nothing that I could really do on long term for them, but they were really grateful just to get a bit of information from me. And as I put it to them, it's karma, isn't it? Spend a couple of minutes making sure that you understand what you're doing, even if there's no business in it for me, and hopefully somebody will do me a favour in the future to go along with that. So please don't be afraid to get in contact with us.
Yeah, please do. Okay, listen, thank you very much for your time, everyone. Have a good evening, and look forward to you on the next webinar, or if you call or drop us an email. So thank you very much.
Thank you.
Thank you.